If you're looking at your monthly budget right now, you know the reality. High fixed costs, EMIs, and at the end of it all, an investable pool of exactly 1 lakh rupees. It is incredibly tempting to take that hard-earned capital and throw it at the latest hyped IPO, hoping to multiply it fast. The market makes it look easy right now. But with a strictly limited capital pool, you have absolutely zero margin for error. A single bad bet destroys your starting position entirely. So instead of treating those limited bullets like lottery tickets, the goal shifts to capital preservation paired with steady, compounding growth. For this profile, evaluating an IPO is about checking the asset against a strict need for stability over speculation. That brings us to Lohia Corp. They have a 40-year track record manufacturing heavy industrial machinery. They design and build integrated production lines for the technical textile industry, specifically the massive circular looms that create woven plastic packaging and fabrics. The scale here is immense. Their consolidated revenue comes in at roughly 1,386 crore rupees, securing their position across global markets. They also convert that top line into actual profitability, posting a standalone profit after tax of nearly 1,186 million rupees for fiscal year 25. The question you need to answer is whether a heavy industrial exporter is a safe harbor for your limited capital, or if it exposes you to deep global business cycles. When a packaging manufacturer buys an integrated production line from Lohia, they are committing to a massive capital expenditure. Because the upfront cost is so high, the client relies on Lohia for core infrastructure and spare parts for years. The relationship is highly retentive. This also ties Lohia's performance directly to global capex cycles. They only make big sales when other businesses decide to expand their manufacturing capacity. If the global economy cools down, those packaging manufacturers freeze new orders instantly. This creates lumpy, unpredictable revenue quarters. This line chart illustrates the dynamic clearly. The smooth line represents predictable subscription revenue, while the jagged line shows the volatility of industrial equipment sales. Investing here requires the stomach to ride out those flat lines. If short-term dips in revenue cause you to panic, this business model will test your nerves. To offset that volatility, Lohia sells machines all over the map, maintaining an export presence in over 100 countries. They drive this through established international entities in the UAE, the USA, Brazil, and Italy. Having revenue dispersed acts as a geographical shield. If the domestic Indian market enters a recession, the company relies on sales in Europe or the Americas to absorb the shock. But cross-border revenue introduces friction. Because they deal heavily in US dollars and euros, they are deeply exposed to foreign exchange volatility. Even if the company sells the exact same volume of machines, a sudden shift in currency values can directly erode their profit margins before the cash hits the bank. While their global reach provides a safety net against local downturns, it binds them to currency fluctuations entirely outside their control. There is also a major structural shift to factor in. In April 2024, the company executed a strategic demerger to organize the machinery business into its current corporate form. This restructuring was specifically designed to isolate the textile machinery operations into one clean, standalone entity. On the standalone balance sheet, they booked exactly 1,186 million rupees in recent profit. Directly above that is a massive capital reserve of over 2,600 million rupees, created explicitly from the transfer of assets during the scheme. This clean split is good for transparency now, but it makes looking back at older, consolidated financial data noisy. It complicates the effort to build a simple, long-term valuation baseline. While the current financials are profitable, that lack of a continuous historical trendline demands caution when evaluating the final IPO price. This brings us back to your specific constraint, deciding exactly where to deploy that restricted 1 lakh rupees of investable capital. If you are a listing gain chaser hunting for a quick, massive multiplier on opening day, stay away. This is not a software startup scaling overnight. For the value compounder, a business with a 40-year legacy, physical factories, and tangible industrial assets acts as a strong defensive choice. You just need the patience to hold through the inevitable macroeconomic headwinds that hit heavy exporters. Lohia Corp operates as a stable portfolio anchor, not a lottery ticket. It earns an apply rating, provided you fit that patient profile. However, a strong business is a poor investment if you pay the wrong price. Here are the final steps. First, calculate the price-to-earnings multiple to ensure the valuation makes sense. Next, monitor the gray market premium to guarantee a margin of safety. Finally, verify that institutional buyers are heavily subscribing. Their capital is the ultimate stamp of approval. Executing this final checklist ensures that your 1 lakh rupees is deployed with maximum protection and long-term stability.